All right, it's 11. It's time to start. Hey, I'm glad everybody's here. My name's Ron Ray, and I am just a member of our community here that Justin Brock has fostered with the Medicare Gurus group. And, I get a lot of questions from agents around my area that I work with about my Medicare sales and also how I turn those into other sales and primarily annuities and financial services. So that's why I put this class together. I thought that there would be a good opportunity to uh, get some information out there and help other agents and also at the same time maybe make a little side money on it selling the class. And so this is kind of the first one, trying it out on you guys for free. I'm not selling it to you, but in exchange for it, what I just want is some feedback. So you give me a little bit of feedback on how I can improve the class and provide value to other people that I'm going to ask to give me money for it, and that'll be good enough for me. So one thing I'm going to do real quick is I'm going to open up my little webcam guard here. I don't like the Russians watching me while I'm doing things, so sometimes I forget to open that up. But this is me right here, and we'll just get right into it. Let's see here if I hit the right buttons. A little bit about me. I own two companies. One's called Turning 65 Solutions. That is my Medicare supplement marketing wing, Turning 65 Solutions, and we just simply do Medicare marketing to people turning 65, just like the word says. And then the other one is Homestead Family Wealth. That is the overall financial services firm. And I've got a health and life license from the state of Texas and a couple other states. I don't sell too much over the phone, so I'm not licensed in 15 or 20 or 48 or 50 states. I'm just licensed in Texas and a couple others where my clients have needed me. Also have a Series 65 securities registration that allows me to provide fee-based financial advice. Been in this business for 10 years, almost 11 now, and this is my second career. Before that, I've been a police officer for about 21 years and still am. I'm a reservist here in the state of Texas where I live, but a few years ago, I decided I wanted to get married and start a family and not have to wear a bulletproof vest to work every day. So I got out of that, and this is what I do now. And since I've been in this business, I've pretty much only worked with people turning 65, going into Medicare, getting ready to retire, recently retired. Now, I've got a lot of information to get to you in the next, 60 to 90 minutes. And this is what you may feel like. You've ever heard the expression drinking from a fire hydrant? That's what it is. I'm going to throw a lot of stuff at you in a short period of time, and you're going to miss some of it. Now, luckily, the session is being recorded, and we'll provide that to you. But if you miss it, no problem. We'll get it to you. If you have questions, you can always feel free to email me, give me a call, send me a message on Facebook through the group, however you want to do that. I'm happy to help, and I'm here to help. I certainly learn probably 10 times as much from that group as I'm ever going to teach to it. So I'm happy to be here and happy to give back some. Just going to tell you a little bit about my practice and how I've evolved that. By the way, I just want to do a check before I get too far into this. Can everybody hear me? If you can, just kind of click that hands up signal. Okay, good. I see a couple there already. Okay, good. Just wanted to make sure I wasn't talking to myself. Thank you. Started out, I left law enforcement at probably the worst possible time in history to ever leave a government job and go out in the private workforce in the fall of 2008, right during the peak of the financial crisis. Companies were laying off workers by the tens of thousands at that time, and wasn't quite sure what I wanted to do anyway. And all of a sudden, I got a call from this recruiter with a company I never heard of called Bankers Life and Casualty. I was out in the Houston area at that time, and he had a good pitch. He told me about all the money I can make and get rich selling insurance to people on Medicare. And I went to a group job interview. He didn't tell me it was that. He said, come on in for an interview. So I got all prepared with my resume and everything and went in, and there was 15 other people in a room, and he talked to all of us at one time, and then that was it. I signed on. He did some math up on the board about renewals and residuals, and didn't really talk about much else. And I didn't know anything about insurance, but I got into it that way. And I got all their training and learned to call people and set appointments on the phone so that I could drive 2 hours and have them not show up for the appointment, or stand there and not answer the door while I was knocking on it. But I got pretty good at the pitch for Medicare supplements and final expense, and learned quite a bit, and went to some of their other training. I was, out of that group of recruits that I was with, I was the one that lasted the longest at about 6 months. But I did get to take advantage of some of their great training and some of the veteran agents that were there, and I learned a lot from them. But in about July, I got a call from another recruiter, and he told me about this world of selling insurance as an independent agent. I didn't know that existed, but I kind of liked being my own boss and not having to answer to anybody. And so I left banker's life. It was a captive situation, and went out on my own and learned to sell individual health insurance, probably in the one of the worst times in history. Learn how to sell individual health insurance over the phone, because that was when Obamacare was enacted and came on, and the individual health insurance market started going downhill from there. And if you were in that, well, you know how that worked out. Then I was still in law enforcement a little bit at that time, and with the Texas military forces, and deployed to the Texas-Mexico border, and spent a year there, and kind of still taking care of some of my clients and doing some telephone sales on my off time there, and came back for about a year and just was fumbling around with some phone sales and networking groups and things like that, not doing really well. And then another opportunity to go on active duty came up, and I was there for about a year and a half, and then came back and really got serious about the insurance business in the middle of 2013, and I got serious about it, and that's where it all started kind of for me. Before then, I'd just kind of been dabbling and figured out you can't make a living dabbling. So jumped into it full bore and have been going strong ever since. So that's kind of what we've been doing. Now, the way my business is structured, and I'm going to kind of bore you for just a few minutes, because I think it's important for you to know kind of how I do this. It's not just me. It takes a team of people, and so what it is me. I own the two companies, Turn 65 Solution, Homestead Family Wealth. I have two full-time employees that work here with me. One is just mainly customer service and marketing, and then the other one is my appointment setter. She just dials and sets appointments from all our leads all day long, and keeps my calendar full and make sure I'm in the right spot at the right time. Currently, I'm set up with one FMO for annuities and two for Medicare, but really just one. I'm kind of consolidating. I used to be of the opinion that you should kind of diversify your FMOs and not have all your eggs in one basket. So if one relationship went bad, you could keep on doing business. But kind of come around to the realization that if you spread it out, you kind of miss out on some of the incentives and rewards and things that go along with any FMO, and then I have my securities license placed with a registered investment advisor up in Michigan. And this is how the business model works. We do Facebook ads for our live Medicare seminars. So we do Turning 65 seminars 2 or 3 times a month, once a month per territory. And then we kind of rotate them around. I don't like to travel too far, so we keep it here kind of close, within an hour's drive. In the San Antonio, Texas area, which is the 7th or 6th largest city in the nation currently, about 2 million people here in the metro area, and live in a town that is for 2 years in a row been the 2nd fastest growing city in the country, New Braunfels, Texas. And so we do those seminars, and then we set face-to-face appointments. I sit across my desk from them, and they come to office, don't really make house calls anymore, and we sell Medicare supplements that way. Used to do direct mail, but that kind of faded. The responses have been dropping steadily over the last couple of years. So we went last year, about mid-year, to Facebook ads for our live seminars, and that seems to be a much more efficient use of our advertising dollars. And this is, I just want to show you kind of a progression of the product. So we really started out with Medicare supplements and working with Bankers Life and Casualty. We're about maybe 40 to 50% more expensive than other companies. Like Mutual of Omaha was big in that area at that time. And it was hard for me to compete, especially knowing what I did, that, you know, Medicare supplements are all the same. So there's really no need to pay 50% more. It's hard to tell somebody that Mutual of Omaha is a worse deal. So I learned real quick how to sell final expense. Hey, if I can't get that Medicare supplement from you, how about you go ahead, I'll give you permission to go ahead and get that mutual plan from this other agent, but we'll get you a final expense plan. And that worked pretty well. And then, you know, just start maturing as an agent, learned about long-term care and annuities, and then got the securities license a couple of years ago and started doing managed investment portfolios, kind of as just an overall. And then, believe it or not, just this past year, started getting contracted to actually sell and get paid for Medicare Advantage plans and prescription drug plans. Never have really done that because of the seminar marketing. Didn't really want to be very restricted at all on what types of marketing I could do. And so I stayed away from MA and prescription drug plans. Always help people with their prescription drug plans. Never just was contracted. Always do it through Medicare.gov. And that way I could just do whatever kind of marketing I want. I don't have to deal with CMS regulations. But this year, you know, we've just been seeing kind of the writing on the wall that Medicare Advantage is getting bigger and bigger as a percentage of the market, and we're just going to have to start adding it, and we're just going to have to deal with the regulations, but that's all right. So into annuities. Just give you a couple of quick definitions. If you look in Webster's, Webster says an annuity is a sum of money payable yearly or at other regular intervals. And Investopedia says it's a financial product that pays out a fixed stream of payments to an individual, and they're created and sold by financial institutions, usually insurance companies, which accept and invest funds from individuals, then upon annuitization, issue a stream of payments at a later point in time. So essentially, an annuity is a stream of payments, usually a fixed amount over a period of time, which could be a lifetime or it could be a certain number of years. What are some examples in the real world without selling an annuity from an insurance company? A pension from your company. When you retire, that pension is annuitized. You have a certain number of options that you can choose from. Lifetime, 50% survivorship, 75% survivorship, 10 years certain. That's an annuity. Social Security, guess what? It's an annuity. When you elect your Social Security benefits, they pay you a certain amount for the rest of your life. It doesn't really change unless you get a cost of living increase. The lottery, if you win the lottery, unless you take the cash option, which costs you, I don't know, 40 or 50% right off the top, you get a 20-year annuity, 20-year payout on your lotto winnings. And that is an annuity. As far as what we're talking about here today, for the context of this presentation, we're talking about annuities from insurance companies. A person puts in a certain lump sum of money and gets a certain number of payments back in exchange for that. Sometimes these terms get confused, annuities versus AUM or assets under management. These are not the same thing. Annuities are insurance products. And when we're talking about fixed annuities as opposed to variable annuities, fixed annuities are not securities. You do not need a securities license to sell fixed and fixed indexed annuities. You only need a securities license to sell variable annuities. So you would need a series, depending on the type of variable annuity, probably a series 6, as well as a life insurance license to sell a variable annuity. For our purposes here today, I'm really not going to be talking too much about variable annuities. I'm going to kind of cover them just so you have some context to what they are, but we're going to be talking about fixed annuities and fixed indexed annuities. Then AUM means assets under management. And when I speak about it here in our context, that's going to refer to fee-based investment advisory services. So I will take your money and invest it for you in managed portfolios. Instead of commissions, you pay me a management fee, usually right around 1% of your total assets under management. That does require a securities license, usually a Series 65. Types of annuities. There's different types. Each one of them has its pros and cons. Each one of them has its use. Most common that you might hear about are single premium immediate annuities, also called a SPIA, and these provide instant income. So the person puts in a lump sum of money, and the insurance company 30 days later starts sending them a check for a certain period of time, usually lifetime, but you might pick a 10-year period certain or a 20-year payout, however it goes. Typically, it's lifetime payout. Then we have the fixed annuity. These are generally referred to as multi-year guarantees or MYGAs. These are very, these are just like the word says, it pays you a fixed rate of interest for a certain number of years, 3, 5, 7, 10 years. These are a good alternative to CDs. If your clients have money sitting in CDs, especially if it's non-qualified money, taxable money, CD rates are still pretty low, although they're coming up. We can usually get them into a 3 or 5 year MYGA for a good amount of money more than they would make in a CD. And then the most common that you're going to hear about, and the ones that all the marketers, the IMOs and FMOs are beating you up all day long, filling up your email box and your voicemail box, is the fixed indexed annuity. This is a good alternative for people that don't like the risk of the stock market, but still need to make a higher rate of return on their money, and also have the ability to get those lifetime income payments. This is the most common. This is what we're probably going to spend the most time talking about today. And this is the kind of the chart that we'll cover this a little bit later, but this is just from a company. I just picked a company that had a chart like this, American Equity, and you can see the red line is the stock market. It goes up and down, and then the blue line would just be a fixed rate of return, 2.5%, and then the green line is your fixed indexed annuity. So you can see when the market goes up, your account goes up, and when the market goes down, well, you don't lose any money. That's a fixed indexed annuity. And then lastly would be the variable annuity. This is for people that don't mind taking some risk with their money because their cash value is still at risk in the market, and so they have a potential to get a higher rate of return. But it's also got some guarantees built into it, like a guaranteed death benefit or maybe even a guaranteed lifetime payment benefit. You just have to understand that the fees are kind of high in these, on the high side, and they still have some market risk. They can lose money. The first 3 are all fixed, so there's no market risk. They're not going to lose any money to the stock market, but the variable annuity, you can definitely lose cash value to market fluctuations. So here's what some problems that these things solve. I'm going to kind of move some things out of the way on my screen so I can see them. I'm at my desk that I meet clients at, and so I don't have 2 screens here. Problems that they solve. The first one, if you're going to do this, I want you to do one thing. Take out a Post-it note and write the acronym TIPS, T-I-P-S, because this is what annuities do. They protect people from taxes. They provide income. They bypass probate, and they provide safety of principal. An insurance company did a study a few years ago. They did an independent study. They spent a lot of money on it. And they asked seniors, baby boomers, what they were most concerned about, and this is what they came up with: taxes, income, probate, and safety. They don't want to pay too much in taxes. They want to have an income that they will not outlive. They want to be protected from probate. They don't want their estate to be tied up in court and eventually going to the lawyers anyway. And they want to have that safety of principal. They don't want to be worried about their money. So those are the four main things that we're concerned with: taxes, income, probate, and safety. Secondary to that, there's also a very, very good conversation starter for an annuity is long-term care. Now, most people, especially by the time they get to me at age 65, have already looked at long-term care, and most of them, I would say 99% plus of the people that I talk to on a daily basis have decided not to buy a traditional long-term care insurance policy for a couple of reasons. Number one, they can't qualify for it because they've already got some health problems. Or number two, it's just too expensive. By the time they get in their 60s, it just doesn't make financial sense anymore. And there's some risk involved with long-term care policies. And I'm not going to sit here, I'm going to take up too much time today and argue the pros and cons of long-term care. What I will say is that I don't like long-term care insurance, but I think you need to have a long-term care plan. And annuities for the people that have the resources are a good solution and a good alternative to long-term care if they don't like the things about long-term care, like the qualifications or the risk involved with paying a bunch of money on premiums and dying in 10 years from a heart attack and losing that money. And I realize that you can get return of premium riders and things like that, but generally it's just too expensive for the people that I work with. If you're working with younger people in their 50s up to their early 60s, it may be a different conversation. But for the people I work with in the context that I'm working in, it's usually too late to buy a regular long-term care policy. So we're either looking at an asset-based program or a smaller, what I would call a mini kind of an indemnity plan, like something you would get from one of your med-sup carriers that might cover a year or 6 months or something like that in a nursing home. Something else, people are worried about low interest rates. Their CDs, their money market accounts just aren't paying anything. They've spent 10 years with, sub 1% interest rates. Those are starting to go up now, although, you look at the markets in the last couple of months, that 10-year treasury rate's back down under 3%. It's probably headed towards 2% this week. And so a lot of the people that we work with in the age group of people that we work with remember the days when CDs brought 8, 10, 15%. They remember those days, and they remember their parents and their grandparents buying a CD, putting it in a bank, FDIC insured, and then simply just living on the interest. Those days are gone, and they're not coming back. They're not coming back. I saw a study, I forget the company that put it out, but it was an insurance company that did a study. It was actually in data from the Federal Reserve that showed interest rates flat for the next 10 years. Those interest rates are not coming back anytime soon. Lastly, some people may be concerned about required minimum distributions. We've got some insurance products. One specifically is an annuity that will delay RMDs until age 85. It's called a qualified, it's called a QLAC. The acronym's escaping me, but it's not a great solution for a whole lot of people because the amounts are limited by the IRS. But again, it's a good conversation starter. If they don't want to take out money at age 70 and a half, well, guess what? We've got a solution that for at least a portion of your money, we can delay that to age 85. So good conversation starter, good marketing, by the way. RMDs, great response on mail pieces, great response on digital ads. Everybody that we work with that has IRA, 401k money, they know that they've got these RMDs coming up. And it's good because it weeds out people that don't have money, because people that don't have IRAs aren't concerned about RMDs. So they're not gonna bite on your ads. They're not gonna come to your seminars and waste your time and your food. So good little tip there. Who's an annuity right for? Little chart here. Just kind of shows you the 4 different types of annuities. Immediate annuities, SPIAs, those are just somebody that's seeking immediate monthly income. For whatever reason, they can't wait. They need to get that income and they want to last for the rest of their lives. There's no growth in it. Once they put in the money, it's locked in. That payment's locked in. It generally doesn't change. That is just going to be what is, and they can't get any money out. When you hear when I hear people saying, well, you know, annuity is no good because if you die, the insurance company keeps the money, that's usually a SPIA that they're talking about. Now, there's different options. The only way that that works is if you pick the lifetime only option. It's only based on the one person's lifetime. That gives them the maximum payout. But if they die, that's true. The insurance company's keeping the money. It's not going to anybody else in survivorship or in a lump sum. Next would be the fixed. It's just going to guarantee them a fixed interest rate. Their principal's protected. They're not going to get any kind of losses. The taxes are deferred, so they don't pay any taxes on that interest or on those gains until they take the money out. And you can add lifetime income riders to it. They can get a lump sum out of it. This is for people seeking an alternative to those low deposit bank account rates. Then we have the fixed index. We have a great upside potential and protection from market loss. They're tax deferred for non-qualified money, and they have income riders available. Lump sums they can take out of them if they need a lump sum for, I don't know, a vacation or a new roof on the house or something like that. They can grab a lump sum out of that contract. And it's good for anyone who's seeking more potential upside while still protecting their principal. Variable annuities are down here on the end. You're going to get your returns going to be based on the performance of all those variable subaccounts. Now, variable subaccounts is code for mutual funds. Remember that. Within a variable annuity, your client's money is going to be invested in the variable subaccounts. And those variable subaccounts are typically made up of a group of mutual funds. There's no principal protection. They're mutual funds. It's the stock market. It's the bond market. They're going to go up. They're going to go down. They do get tax deferred growth though, and they do have lifetime income riders. You can withdraw a lump sum. Of course, all these subject to surrender charges, things like that. We'll talk about that later. So this is right for somebody who's willing to take the market risk, but wants that tax deferral for non-qualified money, non-IRA type money, just regular savings account type money. They get that tax deferral. So when I hear people say, I hate annuities, I know a couple of things. First of all, they probably never had one. And second of all, they're either talking about a SPIA or variable annuity. When I hear somebody say, yeah, I've got an annuity and I love it, they're usually talking about a fixed indexed annuity, sometimes a MIGA, a fixed annuity. Oh, by the way, I'm going to go back to this. When you hear people on the radio talking about don't buy an annuity, or you see somebody on TV saying, I hate annuities, that's also the ones they're talking about, the variable and the immediate. So how do we start this conversation? This is something that was one of the big things when I asked for feedback and what you guys wanted to know. One of the most common responses I got was, how do we start the conversation? It's real simple, folks. This is an easy slide for me. You got to ask questions. If you sell Medicare supplements and you don't do a complete fact finder with everybody that you talk to, you are missing opportunities. You are leaving money on the table. I promise you that. You've got to use a fact finder. So this is a fact finder. I'm not going to go through the whole thing, but basically what I'm just going to tell you is that everybody that comes into my office for the first time from one of my seminars, they've learned about Medicare at the seminar. Now they're coming in to me to get their Medicare supplement because they're approaching their 65th birthday. When they come into the office, here's what I tell them. Folks, I'm glad you're here. This is not my exact script, but I'm just going to give you the gist. Glad you're here. Do you have any questions? Blah, blah, blah. Okay, great. We can get that all taken care of for you. We'll get your Medicare supplement. We'll get you signed up for Medicare. We'll get you prescription drug plan. Here's how we do that. We need to figure out which side of the road you're on, Medicare, Original Medicare, or Medicare Advantage. And then from there, we'll break it down into company and plan and prices and all that. We'll do all that today. And the way we do that is we just have a conversation. I've got a bunch of questions for you. And these questions deal in some different areas, but what they do is they help me get a big picture view of who you are and what you expect. What you expect from me, what you expect from an insurance company, and then I can make a good suitable recommendation to you based on your specific needs. Now, before we get started with that, I want to tell you a little bit more about what I do. I'm not just a Medicare supplement salesman. I'm a financial advisor, and I specialize in holistic retirement planning. Now, what I mean by that is I take these 4 pillars of retirement right here, and I break those down and combine those into one master plan for you. With medical being up at the top, the most important, certainly at the forefront of your mind right now with this deadline you've got coming up for your birthday. But along with that goes long-term care. You know, we don't want to pay your life savings out to a nursing home if we don't have to. And then there's final expenses. We want to be able to pay your final expenses and pass along any wealth that you've accumulated in an appropriate manner. And lastly would be your retirement savings and income planning and Social Security planning so that you can live out your retirement years enjoying the lifestyle that you're used to without having to worry about running out of money or outliving your money. Now, we're going to focus on medical today because that's why you're here. But I'm going to ask you questions in all four areas because it's a puzzle. And if I'm missing any one piece, well, I just don't have a full picture. Is that okay? And everybody says okay. I have 2 people a year push back on any one part of this. It's really amazing, especially after a live seminar. They've already sat for an hour and a half almost in a restaurant, listening to me, getting to know me. Then when they come into the office, nobody ever pushes back on this. Once in a while, they'll say, well, we've already got this side taken care of, or we already looked at long-term care and we didn't think that was it was too expensive, or we've already got a retirement or a financial advisor. And when they do that, I just say, hey, good. I'm not going to ask you to make any changes. I just want to kind of get a picture of where you're at. And they say, okay, no problem. And then we move on and we go through each one of these 4 steps, starting with medical. Then we go to long-term care, life insurance, and then we get into their money. And everybody just spills the beans with no hesitation. Now, once we go through that, I'll say at the end of the fact finder, what I'll do is I'll say, hey, thanks for that information. That really helps me. And I think, you know, from everything you've told me, you're a perfect candidate for a Medicare supplement. And then I take about 5 minutes. I do a quick review from the seminar, reminding them the differences between a supplement and Medicare Advantage. Maybe it went the other way. Maybe I think they're a good candidate for a Medicare Advantage plan. I'll kind of retrain that in them, give them 5 minutes. Then I'll give them a couple of choices. Really, the only choice I'm giving them right now is Plan F or Plan G. I do the math. They say, well, that's a kind of a no-brainer. Plan G just makes more sense. I haven't really gotten into the what's going to happen, figure out how I'm going to word that when the Plan F goes away next year, but we'll have to figure out how to do that math on the G and the N. I think it'll be a pretty simple thing. It may be a little bit harder decision for them. But first things first, we get the MedSup. We do not jeopardize the MedSup sale by pushing on the other 3 topics. We get the MedSup, make them a client. That's the low-hanging fruit. Grab it. Grab that low-hanging fruit and run with it. Once you get the MedSup app, here's what you do. You tell them, folks, we're going to get this all submitted for you. The insurance company is going to send your policy and your ID cards and everything to me. So we're going to need to get together again anyway in the next couple of weeks and get that delivered to you. And by the way, you know, we talked about this IRA that you have. Once you let me get a financial analysis done on that, we'll check on the fees, check on the risk, make sure that the risk that you're taking actually coincides with the risk tolerance that you have. A lot of people find that what you think you have is not really congruent with what you want that product or that investment to be doing. So let's make sure that those are in line. And all I need to do that for you is you just bring me or send me a copy of your latest statement for your investment, Social Security statements, if you want your Social Security optimization report. Also, your latest tax return. We can run some what ifs. Say, you know, it's usually too late to fix what you've already done with your taxes, but what I'll do is just a side-by-side comparison, take your tax return from last year. Well, maybe we're able to move some money around and defer some taxes and show you what it might look like next year. Just bring me your latest tax return. And if they say no to that, you've still got that second appointment to deliver that Medicare supplement. So now that's going to work great when you're face-to-face. If you're on the phone, we're probably going to have to finesse that a little bit differently. I think just off the top of my head here, you probably want to set a second appointment anyway after they get that policy. Some of the carriers I know will alert you when the policy's been mailed, so you can reach back out. Hopefully you're doing that anyway, doing some follow-up with your clients after you've sold them. Make sure they got the policy, kind of walk them through a couple of pages, make sure they've got the ID cards, that kind of thing. And that's your excuse to get back in front of them again. And if you're meeting with clients face-to-face and you're not delivering policies, you're missing opportunities. Every one of those policies that you have sent directly to your client because you don't want to have to take the time to deliver it to them, you're missing opportunities. You're leaving money on the table. I promise you that. Deliver those policies. Some MedSup carriers allow you to select in the e-app or in the paper app where you want it delivered. Some of them don't. They don't give you the choice on the application. But what I found is if you call up the carrier, I don't know, Cigna is one of them that does this. It's not a choice on the app. But if you call them, you call Cigna and tell them, I don't want you to send the contracts to the clients. I want you to send them to me so I can deliver them. They will do that. I remember that's what I had to do when I started selling Cigna. After that, you're going to send them something. If you get into that fact finder and you find out that they've got $250,000 IRA and $100,000 investment account, and it's all in, I don't know, Raymond James or Charles Schwab or Wells Fargo or something like that, you're gonna have a quick conversation with them about it. Don't get into too much detail during the fact finder. Just ask them the questions on the page and kind of make some notes of their responses. But after that, either when they're walking out the door or later, you can write a little note out, handwritten note saying, thanks for coming in. By the way, I just included this little book that it's one of my favorite books about retirement. It's very plain English, how, just people like you and me can understand it. And this is one of the best ones that I found, but you just want to give them a little something. And I don't make any money from this. In fact, you can get this. Some of your FMOs will give them to you. I know mine sends me in by the case. I give them to my clients. It's all about fixed indexed annuities, but it's presented in a manner, well, it's not salesy. It just tells them about retirement and how to make your retirement stress-free. And I give them that book. Sometimes if we've talked about a certain topic, I might highlight a chapter that covers that topic in the book and just say, my note say, hey, Bob, by the way, this is my favorite book on retirement. It's got some good stuff in it, but I think you'd be very interested in chapter 8. Send them that. Give it to them before they leave. Then you want to send them some third-party credibility. You need to be doing stuff outside of just selling. So there's ways that you can get published. I've got articles on CNN Money. I've got articles on Forbes, and on Forbes, I'm not there. They've got the program, the Financial Council. That's fairly expensive. It's pretty good credential, but my FMO does this for me for free. I write the articles, they get them published, and of course, it's all you've got to be producing. They're not going to pay for it for a non-producer, but I think the point is here, have some third-party credibility. By the way, I wrote this article for CNNmoney.com, 4 Pillars of Successful Retirement. Just so happens to cover the 4 areas that we talked about today. If they're concerned about taxes, I'll give them this article, 4 ways to take advantage of Trump's new tax code right now. Covers, the new tax code is very timely information, even though it's, almost 2 years old now. It's still very timely. So that third-party credibility is really, really good. And, I think there's other ways probably to do that than paid advertising. If somebody's got a blog or a podcast or a YouTube channel or a Facebook group, you can go in as like a guest commentator or guest writer and write posts like that. And I think it carries a lot of weight with people. Now, during that second appointment, we're going to get some do some more fact finding. So they come in for that second appointment, whether they're just coming in for the delivery of the policy. We're going to take care of that first, get that out of the way. Then they're going to show me all their documents. They're going to give me their statements and their social security statements and their tax returns. And we're just going to go through them. I'm going to look at them. I'm not going to comment too much. I'm just going to look at them and say, yeah, you guys have done a good job. You've accumulated a good amount of money. Now we need to dig into it and just kind of find out, what it's doing for you, what it's costing you, what it can be expected to do for you in the future. Ask them some more questions, go through a little questionnaire about risk tolerance. And then I'm going to just kind of close the meeting. This is not a very long meeting. Kind of close it with this line right here. It says, looks like you two have done a great job so far. Now I've got a lot of work to do. I've got to get into all of this and really dig into it and do this analysis for you. I'll have that done in a couple of days. How's Wednesday at 1 o'clock? And set that third appointment. Now at that third appointment, we're going to present the solution. Now, in the context of this presentation, I'm not going to get too deep into what money goes where. We're not going to talk about, what to do with mutual funds versus what to do with bonds versus what to do with 401ks or things like that. We're just setting the appointments. That's training that you can get from other sources or me, but usually your FMO, your annuity FMOs. Please pick an FMO. I don't care which one it is. Pick one that specializes in annuities. Don't just go to your, I don't know, let's say, well, your Medicare FMO and say, hey, by the way, do you have any annuity companies? And they go, oh yeah, well, I don't know, this MedSup company over there, they sell some annuities too. And, may not be the best deal out there. So pick an FMO that specializes in annuities, or pick a registered investment advisor that specializes in your demographic of people. And they'll have great training for you. The annuity carriers have great training. I can provide you with training. Other agents can provide you with training. Get to know people, network, and learn. Some of these carrier trips, a beach is a beach, although Aruba was nice, I have to say. A beach is a beach. Go for the people. Go and network with the people, get to know them, learn things from them. And that's some of the greatest things that I get from these incentive trips. And set that third appointment. And then all you're going to do is just kind of solve the problem. So if their problem is they're paying too much in taxes, but all their money's in CDs, well, they could maybe benefit from a tax-deferred fixed annuity. Or if they are concerned about long-term care, but maybe they can't qualify medically, well, we might be able to set up an asset-based program, a indexed annuity that has an income rider that has a doubler or a tripler for long-term care, or one of the newer fixed annuities that is set up for long-term care. It's got a kind of a mini long-term care policy as a rider on it, so it maybe doubles or triples their lump sum for long-term care. If they're concerned about RMDs, let's look at QLACs, Qualified Longevity Annuity Contract. Just remember what QLAC stands for. Complete the case design, kind of get your presentation together, talk it through with your FMO person that you work with. They should be able to kind of walk you through the presentation until you get confident doing it yourself. And then present the solution to them. Say, folks, hey, you've done a great job. You kind of told me some of your concerns. Here's some of the things that I found, and here's how I present to fix it for you. So you've got, I don't know, let's say one of the biggest problems I find is that people may have a variable annuity that they bought when they were in their 40s or in their 50s, and they didn't realize that they're paying 4% in fees every year for riders and sub-accounts that they're really never going to use. So maybe we want to keep the safety of an annuity, but get rid of the fees. So maybe we'd do a 1035 exchange from that variable annuity over to this fixed indexed annuity. So you're getting similar performance without the fees. And they say yes, and you get the application. Now, when we're talking about money, I'm just going to kind of give you a very quick presentation how I do things. As we talk about how I present this to people, is talk about two different types of money: discretionary money and non-discretionary money. And it looks like my titles are backwards there, but non-discretionary money is on this side. This is money that you need to spend for things that you have to buy, like food and your pay for your house and your health care and your taxes. This is money you have to spend. You have no choice. We want these bills paid for with guaranteed sources of income. Sources of income like a pension, if you're lucky enough to still have one of those, Social Security, and whether you like them or not, annuities. And these are the only three things out there that will provide you with a guaranteed source of income that you cannot outlive. And that's what we want to pay for non-discretionary spending with. And then the other type, of course, is discretionary spending. These are for wants, not needs. Things like a new car, traveling, or spending money on your grandkids, things like that. For that, we want to keep that money liquid and take smart risk with it, well-educated, well-informed risks. And we're going to do two things with that. We're going to provide liquidity, because the three things on this side aren't very liquid. And then we're going to get a potential higher rate of return. We're going to combat inflation over the next 30 years of your life. And then I'm going to show them a presentation that looks very similar to this. It just simply shows the red line versus the green line, and the conversation goes like this. This is the stock market. The red line is the S&P 500. Maybe you've heard of that. It goes up, it goes down, it goes up, it goes down. Over time, we know that it ends up going up. But the question is, where is it going to be when you need it? And then the green line here is something called a fixed indexed annuity. And you can see here, when the market goes up, your account goes up, but when the market goes down, you don't lose any money. You don't make any money that year, but you don't lose any either. And you can see over time, it has outperformed the stock market. Now, which line do you like best, the red line or the green line? That's the question. That's how you put it to them, and it's very simple. What do you like best, the red line or the green line? What do you think they're going to say? Well, I like the green line. Okay, there's two catches to the green line. The first one would be caps or participation rate. You see, to give you the protection from the downside, they can only afford to pay you so much on the upside, and then there's a cap. So you're not going to get all the gains of the stock market. You're only going to get a portion of them. But of course, you're not going to get any of the losses. And then the other catch is time. This is time commitment, somewhere between 3 and 10 years. We don't like to go out more than 10 years. And in a lot of states, most states now, you can't, for people in our age groups, you can't really go over 10 years. But for that period of time, that 3 to 5 to 10 year time commitment, your liquidity is going to be limited. You're only going to be allowed to take out a certain amount of money. And if you take out more than that amount, you may be subject to surrender charges. Another word for surrender charge would be penalty, early withdrawal penalty. Just like your CD has, you take out money during the 18 months or the 3 years of the CD, you pay a early withdrawal penalty. With annuities, it's called a surrender charge. It's simply just a fee that you don't have to pay if you don't take out too much money in any one year. There may be fees for riders. If they have a guaranteed income rider, they may pay a fee for that. But you just have to explain these catches to them. Look, the green line looks really good. It looks too good to be true. It's not, but there's a couple of catches. Then you're going to show them an illustration, and this one, just as an example, these people started at age 61 with $600,000, and you can kind of see over this 30-year period from 1989 to 2019, this is kind of what it looked like. Now, this is a hypothetical. This is not guaranteed, but the average return you can see here was pretty good. There's a couple of 0 years, but they still averaged in 30 years, averaged 8.22% in this annuity. Now, this is a pretty good fixed index annuity. This is not typical. This is a newer annuity from a company that I work with, and you can show them, look, this is your accumulation value every year. You know, of course, this is hypothetical, so you might not make 21%, but once you make that, once you get credited that 21%, well, that is your new balance. That's your new principal, and that's locked in. You'll never lose a penny of that. The only way you see that go down is if you pay fees or if you make withdrawals. And then you can see over here the guaranteed death benefit goes right along with the accumulation value. And then you can show them, look, and here at age 71 and a half, age 70 and a half, because now they have to start taking required minimum distributions. You're taking out these required minimum distributions every year because Uncle Sam says it's time to pay up. You started with 600,000. You took out 2.1 million, and you still, at 30 years, when you die at age 90, your beneficiary is still getting $1.8 million. Now remember, I want for everybody on the presentation today, this is an illustration. This is their hypothetical page. There's another page that shows the guaranteed amounts. It's going to be much lower than this. This is the hypothetical based on returns from this time period. And then we do something with their portfolio. Now, a lot of you are not going to be able to do this if you don't have a securities license. I do really highly recommend you get that Series 65. It's not that hard. It's not that expensive. And it allows you to talk about things that you can't talk about when you have an insurance license only. And it also allows you to get all of the client's money, not just the amount that you're allowed to put into an annuity. It's very important there. Because when you have an insurance license only, you don't have a securities license, annuity companies, as a consumer protection, can only put a certain percentage of the client's total assets into an annuity and tie it up for 10 years because they have limited access and surrender charges. So they have to leave a certain percentage liquid. Well, if you have an insurance license only, you don't have a securities license, typically what you're doing is you're leaving that liquid percentage with the other advisor. So you can never get that other guy or other gal out of the picture. With the securities license, you can get them out of the picture completely. You get care of all your clients' money. And it also allows you to do things like this Monte Carlo simulations. And what we do with this is we take, excuse me, we take their current portfolio, their current financial plan, and we run it through some simulations, 1,000 different scenarios, and it's a computer generated thing. It's called a Monte Carlo simulation. And I don't know how it works. It's like going back to my law enforcement training. You don't have to know how an Intoxilizer 5000 machine works. You just have to know how to push the green button. And that's all I have to ever testify to in court. Well, this pretty much works the same way. I don't have to know the internal workings of how a Monte Carlo game works, but I just have to know how to explain the results. And the results show that with this couple, we know that on their current plan, based on their life expectancy, about 94 years, that's how far we draw the simulations out to, and based on their current lifestyle, they have a 100% chance of success. They are not going to outlive their money. And these are going to be their returns over time. So you can see the best case scenario, the 90th percentile, they're going to end up with almost $8 million. And the worst case scenario, there's a pretty big difference there from 8 million to 1.5. They're going to end up with $1.5 million. But the 50th percentile, their probably scenario, they're going to end up at their end of their life expectancy with about $3.6 million. You guys have done a great job. Now what I did was I applied my investment style to your money, and I ran these simulations again. And here's what I came up with. Based on the way I do things, your current lifestyle and your current tax situation and all those things, your current income, the 50th percentile is going to come out with about $5.1 million. So what do you like better, 3.5 or 5.1? Very simple question, folks. What do you like better, 3.5, 5.1? Also, that worst case scenario looks a lot better as well. It's double. What do you like better, 1.6 or 3.1? 1.6, 3.1. Which one do you like better? And what do you think they're going to say? They're going to say, well, we like your plan better, Ron. How do we do that? Just need a copy of your driver's license. I'll get you a fresh cup of coffee and we'll get the paperwork done. It's really that simple. Now, if you have an insurance license only, you're going to have to figure out how to do this through your FMO. They're going to be able to do some case design for you that'll give you a similar presentation. It's not going to be exactly like this, but it'll be similar. And these are really the three things that the people have to agree. You have to be congruent with what your beliefs are and what their beliefs are. You have to believe in safety of principle. They have to believe in safety of principle. You have to be able to provide a reasonable rate of return. And by reasonable, I mean somewhere between 3 and 6%. That's kind of historically what a fixed index annuity is going to do. And then last, we need to keep it simple. We're not doing anything fancy, folks. Fixed indexed annuities, fixed annuities, they're very simple. The contracts are about that thick when you get it, versus a variable annuity is about that thick with all the different prospectuses of all the mutual funds available. Fixed indexed annuity is about that thick, and about that much of it applies to most people, because the other is all the different crediting strategies. You only need one or two. You don't have to get into them. You need a simple annual point-to-point on the S&P 500 and maybe something with a participation rate or an uncapped strategy for a couple of years. Very simple. If there's disagreement between you and your clients on any one of these three things, you probably don't have a deal. If they're not concerned about safety, they're not going to buy an annuity. If they don't think that 3 to 6% is a reasonable rate of return, don't sell them an annuity, because they are not going to be happy. If they like complicated, fancy, shiny investments like Bitcoin, like real estate investment trusts, like limited partnerships, like private equity, you're not going to have a good client there. They're never going to be happy. These are the three things that we're looking for. Safety of principle, reasonable rate of return, somewhere between 3 and 6%, and we have to keep it simple. Those three things, if you can all three agree on those three things, then you've got a deal. Then write the business. You're just going to simply get the app. Number one, be sure you're properly appointed. Most insurance carriers these days are doing what's called just-in-time contracting. So they'll get you almost all the way contracted enough to be on board with them and be able to solicit business, but they're not going to appoint you until you provide that first piece of business. So when you send in your first application, that's when they'll go ahead and do the state appointment for you. Make sure you have the right license, the right certifications. I know Texas requires an annuity certification and some ongoing annuity CE. Make sure you check that with your state. And then almost all insurance companies now, depending on the state that you're in, are requiring product-specific training. Now, you only have to do that one time, but you have to do it before you sign the app. If you turn in an app and you haven't completed this product-specific training, it's going to get kicked back, and you're going to have to go back to the client and resell it and get new signatures on that application. And then you're going to follow up with them. After you get that, you're going to thank them. You're going to give them something nice. Send her some flowers. Give them a gift card down to the restaurant. Again, check your state rules on that. Every state's got some different limits on how, monetary value of gifts. Certainly can't give them cash, but a gift card is okay. And but again, check your state. In Texas, we generally have a $50 limit on gifts like that. But always, do something nice for them. And then follow up. Every week, once a week, you're going to follow up with 3 phone calls. You're going to call the carrier that you submitted it to, make sure it's in order, and make sure they're on the ball processing it. Then you're going to call the surrendering company. Once that your carrier has approved the policy and sent off the transfer documents to the surrendering company. Now you're going to start following up with the surrendering company. Make sure they receive the documents. Make sure they are processing them. When it comes to securities, they have a deadline. The SEC puts a deadline on them. Once they've received a request from the client to transfer those securities, there's a deadline, and they can't wait. It's a very short deadline. Now with insurance companies, if you're surrendering a life policy or you're doing a 1035 exchange on an annuity, they're going to want to conserve that business, and they're going to take their time. They're going to call the client. They're going to send them scary letters that say, hey, you know, you may have penalties. By the way, you know, you're going to pay a lot of taxes on this transfer. You need to probably prepare your client in advance for those phone calls. The other broker's going to call them and tell them what a stupid mistake they made. Prepare them for those calls and say, you know, you don't have to tell your other advisor anything. He obviously hasn't been doing a good enough job for you. If he was, you wouldn't be making this move right now. So just tell him, hey, I'm sorry, Dave, we're just going a different direction, and let that be that. By the way, chapter 15 of that book is how to leave your broker. And then you're going to follow up with the clients. Don't leave them hanging. They're going to want to know what's going on with their money. If you're moving a $500,000 IRA, don't keep them in the dark, because if you do that too long, they will call the insurance company and cancel that transfer. So you can call them once a week and just kind of give them a status update. Then once the money is delivered from the surrendering company to your company, then they will issue the policy. They'll send it all to you, and the client has to sign for it. So unlike MedSup, generally, even though we're doing the delivery, there's not really a delivery receipt that the client has to sign. With annuities, that's a different story. They need to sign for it. There's a couple of things you need to point out, like surrender charges, bonus recaptures, crediting methods. Definitely want to point out their balance. You know, if they put in $100,000 and there's a 5% bonus, you need to point that out, make them feel good. Hey, look, you already made it guaranteed 5% this first year, and your balance will never go below $105,000 unless you pay fees or make a withdrawal. Sign right here. Just like any other insurance policies, annuities have a free look period. Depending on the state or the company that you're in, it's going to be 10, 20, or 30 days. Generally in Texas, we have 30-day free look. And the clock starts delivering when that contract is delivered. So do not sit on that policy before delivering it. As soon as you get it, make that appointment and get that policy delivered. The free look clock starts ticking when they sign that delivery receipt. So if you hold on to it for 2 weeks before you deliver it, they've now got a 45-day free look period, okay? And you're generally paid upon issue. So, you know, it's 100% chargeback to you if they free look that policy. And so please, also another tip, hard-learned lesson on my part was don't spend that money. Don't spend that commission until that free look period is over and it's nice and safe. Another thing about chargebacks, if your client dies in the first year of the contract, there is generally either a 50 or a 100% chargeback. So, and some carriers will grade that, you know, at 6 months, it'll go from 100% chargeback to 50% chargeback. So if you're working with an 80-year-old, you want to be careful about what kind of contract you're putting them in, if any at all. May not be appropriate, may not be suitable, and you want to know a little bit about their health. Don't sell a 10-year annuity to a stage 4 cancer patient that doesn't have a good prognosis. It's not good for them. It's not good for you if they die in the first year. Required minimum distributions. This refers to people who have qualified money, IRAs, 401k type money. At age 70 and a half, they're required to start taking a little bit of that money out every year. Some annuities are RMD friendly in the first year, some are not. You need to know, because if they are required to take an RMD in the first year from that contract, that amount of money that's taken back is usually charged back to you. So what you want to do in the case, if it's RMD friendly, no problem. If it's not RMD friendly, what you want to do is you want to set aside some money outside of that annuity. Make sure they've got it in a savings account or their checking account, so so that it doesn't have to come out of the annuity and charge back to you and potentially cause them a surrender charge at the same time. Annual reviews, these are very important. We all are used to doing annual reviews for our Medicare clients, but if those slip through the cracks, it's usually no big deal. We're usually not leaving a whole lot on the table for doing that. Although one of the biggest reasons I make sure to do all my annual reviews with my Medicare clients is I want to find out more about their money. It gives me another opportunity to talk about things. By the way, while you're here, let's just update your information on my forms here. How's it IRA doing? I know you had an advisor down there. Oh no, he retired, he got out of the business, we don't like the new guy. Hey, good opportunity to let me take a look at that and see if I can help you. Also with the annual reviews with the annuity clients, you want to keep them informed of what's going on. They are fixed annuities. They are not going to get a monthly or a quarterly statement. They're going to get a statement once a year because that's when the interest is credited. So keep them informed, keep them confident in you and what you're doing for them. And also other things may have come up. They may have new money to invest. The CD expired, or they were able to get a deferred compensation from their employer, or they got an inheritance from somebody and they don't know what to do with it. You're never going to know about it unless you ask. And these annual reviews are the perfect opportunity to ask those questions. All right, now I've got some questions here, I think. Let me pull this back up and see who all's got questions. Hold on. Am I recording this? Yes, I am. Somebody said they couldn't hear me. But I did ask, hopefully I didn't go through that and no one could hear me the whole time. I asked at the beginning if everybody could hear me, and people did respond that they could. Can everybody hear me now? Hopefully I didn't just go through that whole thing and nobody heard me. Okay. Will you be recording this? Are you recording this? I can't hear you. Ron, great job so far. I guess John could hear me. Thank you for that, John. Could I receive a copy of that fact finder? I don't see why not. No need to answer in this video. Okay, won't do that. Okay, had to go to a client meeting. Yes, can hear. Yes, yes, yes. Okay, great. All right, so that was all the questions. There's a couple little things that I want to add here. The first one is I want you to make one big assumption, and it's going to sound silly, but I think it's important. I want you to assume that nothing that I said here today is actually compliant. I want you to be sure and do your own homework. Check your state regulations, check with your insurance companies, check with your compliance officers, and make sure that you don't do anything that is going to violate your license. If you are insurance license only, you cannot talk about securities. You cannot give investment advice. So be sure and talk in general terms. You can say things like, the market is risky. You can't say things like, well, this mutual fund that you have is risky. That's a little too specific in talking about that one security. You can talk in general terms. Please don't get too specific if you don't have a securities license. You will get in trouble. You never know when you've got a regulator sitting in front of you that has either been sent as a secret shopper or maybe just wants some answers, but on their own retirement. You know, state regulators need to retire too. But you say something that's not right, and now all of a sudden you are in trouble. And our number one asset, the number one asset that you have as an agent is your license. If you lose that license, you are out of business and you are flipping burgers. So please don't assume anything that I said here today is compliant. Do your own homework, make up your own presentations, run them through compliance, make sure that you're doing things right. Now, I know that I'm doing things right, but I don't want you to take that for granted because we are a We are a diverse community here in the Medicare Gurus group. We're in all different states and jurisdictions. So please, please, please check that, verify, do your own homework. And if you have any questions, guys and gals, please feel free to send me an email or a Facebook message. You can find me right there in the Medicare Gurus group. And that's about all I have. We'll see if there's any more questions that have come in. Nope, there's not. No more questions. I will see you guys in the group. Happy selling. Go out there and make some more money today. Thanks, folks.